Okay, hi, I'm Fran Boait, and I'm from the organisation Positive Money. So thanks for inviting me along. We're a research and campaign organisation. We're going for about 4 years, concentrating on researching how the money system works, some of the problems it causes, and proposing ways to change it. So I'm going to talk for a few minutes on this title, which Chris asked me to talk about, how to rebalance the economy. It's quite a buzzword used at the moment, especially amongst politicians. There's kind of this sense that we've had a financial crisis, a bit of reform. We're trying to kind of rebalance the economy away from speculation and housing bubbles and towards maybe useful things like renewable energy or energy saving measures. But there's still not a kind of tangible, how are we going to do it? And so what we look at Positive Money is what we think is kind of a more important underlying part of this question, how to rebalance the economy. And that question is, how does money work? So we're trying to kind of push a debate in economics, in politics, in the media about the money system and why that's crucial if we really want to rebalance our economy. So most people, if you ask who creates money, will tell you the Bank of England, because the name is printed on the banknote. But in fact, cash and coins make up 3% of pounds sterling in the UK economy. So quite a small amount now. And the 97% is made up by electronic accounting entries. And these are not created by the Bank of England, but created by commercial banks when they make loans. So when you or I go in to take out a loan, be that for a mortgage or a business loan, and a bank lends, it creates money when it lends to you. So you can see how that situation's changed from the early 60s up to the 2012. And that's the green line shows cash, and that's steadily increased issuance from the Bank of England. But the electronic money, which is issued by banks when they lend, has been really rapidly increasing. So it's 97% of our total money supply at the moment. Okay, so, and we have in the UK, as Ruth kind of alluded to a bit earlier, a very undiverse banking sector where we have 5 big banks which control, I think, 85% of the market share. So even places like the US have more regional banks, more credit unions, which mean that there's slightly more diversity in where the lending gets to. But in the UK, it's very undiverse monopoly. So most even economics textbooks have a description of banks, which is that they take savers' deposits and that they lend them to borrowers. But as I've just alluded to, that's completely untrue. What banks do is that they create money when they lend, and they decide where to lend based on the profit motive. And that's really kind of the key bit that I wanted to talk about today, really, is where they get to put the new money that they create. So this just shows the percentage of money going into each sector during the 10 years up to the financial crisis, so 97 to 2007. And actually, 40% of that went into mortgage lending, which caused a big house price bubble. And what's also kind of alarming is that that wasn't actually new people getting on the housing ladder. That was mostly, people buying multiple homes to speculate on house prices going up. The actual number of homeowners decreased in that time. So it really wasn't more people being able to afford to buy their own house. It was people speculating in the housing market. 37% of new money went into financial markets. And what people think banks do, which is take savers' deposits and lend to businesses, or just lend to businesses, was actually only 13%, so actually a fraction of what they do. And a further 10% went to credit cards and personal loans. So banks really get to make the decision about money allocation into the economy, and they don't generally put it into what we need, the productive side of things, for various reasons, but mostly because it doesn't, it's not as secure, and they don't get to it's not as profitable. And instead they prefer to put things into mortgages, because they know if someone defaults on their loan, they can take the house, and speculation. And actually in 2008, I think, only 8% of new lending went into the productive part of the UK economy. So this is just a graph to show various things relative to 1991. So the purple line is house prices, and they increased threefold between the early 90s and 2007. A lot of people talk about population growth and housing stock as being the main drivers for this bubble. And whilst there is definitely issues geographically, in the southeast especially, the actual main driver of this bubble was the fact that banks have this ability to create money and lend it into mortgages. And so really that outprices a lot of people from the housing market. And this is just a quick quote from the Resolution Foundation talking about the fact that a sixth of UK mortgage debt sits with households who have less than £200 left at the end of each month. And so there's this kind of 600,000 households which spend more than half of their income on debt repayments. And they kind of call them debt peril. So as a nation, we have the highest level of personal and household debt ever. And that's largely because of this system where to get new money into the economy, we have to take on debt. And we even have a housing minister that thinks this is a great thing. So he said this, I think, at the beginning of the month. Rising house prices are a good thing. There's a real idea that if house prices just keep going up, it's good for the economy and good for everyone. But essentially, we all need to live in a house. So if the most part of our income goes to either rent or mortgage repayments, then if house prices carry on rising, it's not necessarily good for anyone. And then we have the situation where, because all new money is issued in this way, then debt rises at the same amount, and the kind of high levels of private debt precipitate financial crises. So yeah, we have a system where essentially we let banks create all our money by lending, and so we have to repay it all with interest. So we effectively rent our currency from the banking sector. And more than that, if banks don't lend, then there's no money. And because all of our money is based on debt, if they stopped lending, then the actual amount of money in circulation shrinks and we tip into a recession. So we really rely on banks continually lending to keep the economy going. I've just realised am I out of time?
Pretty close, Fran.
Okay.
You might move on to what you see as solutions.
So I might not talk about quantitative easing because it might take a little while, but essentially all it did was push up stock prices and make the top 5% that own stocks richer. And what we're kind of proposing at Positive Money is that it could and should be different. You know, if we're going to face the big challenges we have of climate change, energy, security, etc., that are coming in the next few decades, then we really need a money system that works in the public interest. So we have a system where if we want more money, we have to create more debt. And if we want less money, if we want less debt, then we have less money. And this is what we want. But in the current system, it's not possible. We propose it should be, and that the decision between how much and what for gets split, and the how much should be done in a similar way to quantitative easing by the central bank, but the what for is done by the government. The elected government supposedly represents us. And this would be a much more effective way of getting money debt-free into the economy to do the things that we need. So just as an example, 10 billion, which is a tiny fraction of what they created for QE, which was 375 billion, could be credited to the government accounts, spent on potentially tax cuts or citizens' dividend, or spent into creating affordable housing, retrofitting housing stock that we've already got, also distributing money, like the discussion was talking about earlier, distributing money to local authorities to actually spend it on flood defences and schools that we need. So it's not putting money into things we actually don't want, like blowing up housing bubbles, the financial sector, high interest loans. It's putting it into the things we need, which is salaries and the real economy, to create jobs, sustainable jobs preferably, for things that we need. So we don't want to see headlines like this anymore, where because of there's no money, then all of these very important things are getting scrapped, such as school building or flood defences. So I'll just end on this hopeful slide that there is, if we change the way the money system works, there is a potential to do something useful with it, rather than kind of resigning ourselves to having more expensive housing, a very unstable economic system, and more speculation. Thanks very much.